And we're live. Good to be back. So, we're here again in a different setting, but today I want to talk to you guys about life insurance. Now, I'm going to review life insurance as if I were reviewing a policy with a customer. Okay. I come from the life insurance industry. I'm no longer in that industry actively, but I became very, very proficient at and efficient at selling life insurance. I became part of the $1 million round table of financial professionals. I became top in certain categories in the company, and I sold a lot of life insurance, and I did it for over 8 years. I was 29, 30 years old when I hit the $1 million round table, which meant that I had reached a certain amount of sales that it was recognized by the whole industry. Now, I worked for a very, very large insurance company or insurer in the state of California. And one thing right off the bat I want to say is that this is going to be like a policy review, but every state is different, every company is different. These are just general ideas of how life insurance works and how I would typically review it with a customer. I haven't really talked too much about life insurance on this channel, so it's going to be a good refresher, especially it's something that I really actively did all the time and actually really enjoyed doing. Up until 2021, beginning of 2021, where I made a career change, I was doing this day in, day out, running about 3 to 4 appointments in person a day, plus phone appointments. I mean, it was a great thing, a great business. And I'll make another video if you're in the life insurance industry or thinking of getting into it on some of the things to look for, positives and negatives. But this is going to be a policy review. Let's get into it. So the first thing you need to know right off the bat is when you're getting life insurance, the factors are going to be your age that you apply, your health at the time that you apply. Those are the two main factors that determine the rate or the price that you pay. And life insurance is like any other insurance policy that you own, whether it's health insurance or car insurance. You're paying a monthly premium, typically a monthly payment to an insurance company or insurer, which is making sure that if something were to happen, they will come into place and provide the majority of the coverage, right? So for example, with health insurance, you pay each month a premium so that if you ever had a major surgery or you ever had to go to the hospital or needed something, they're going to cover a good chunk of it instead of you out of pocket. And the way that insurance works is essentially it's a pool of funds. So the insurance company on the life insurance side collects my monthly payment, your monthly payment, my neighbor's monthly payment, and they pool together a pool of funds that they go on and they invest. We're talking the insurance company. At the same time guaranteeing that if something were to happen, whether it's a car accident, a death from life insurance, or a health claim from, let's say, a health insurance, that they will provide the coverage at the time. Now, you want to go with reputable companies. How do you know that it's a reputable company? One of them is you want to make sure that they're what's called an A-rated carrier. They are high ratings when it comes to the insurance quality, the service, the claims, because there are insurance companies that are very low rating, and at the time of a claim, they can potentially, even though it's unethical and illegal, can do some things to try and deny claims. We've all heard of those. We've all heard of attorneys that get involved, and insurance companies have a really, really bad reputation sometimes. But for an insurance company that is reputable, you want to go with one of those, a big named company that has been around for a long time. I worked for a very, very large, one of the top companies, the biggest companies in the state of California, insurance companies. And so they were reputable. And so I got to see the process from writing a policy. And unfortunately, when you're writing life insurance, the reality is that if you're in the industry long enough, you'll see also when it's used. So I specifically remember sitting with Some families that actually became friends over the years, right? Your clients become friends, not just a customer. And I saw where one couple in particular, I'll share with you guys, I sat with them, a husband and wife. Um, they were neighbors of ours. We met with them at my office. We wrote a life insurance policy for both of them, the husband and the wife, and they listed each other as beneficiary. And I'll explain what the beneficiary is in detail. But essentially, the beneficiary is the person that you're naming for your life insurance to go to when you pass away. And life insurance is a lump sum. It's in the state of California, and unless laws changed, and you can check with your tax person, this is not financial advice, all that good stuff. Life insurance is a lump sum tax-free death benefit typically. So when we say a tax-free, we're talking about income tax-free. So if you have a $100,000 life insurance policy and you list your spouse or your brother as a beneficiary and you were to pass away and it's covered under the life insurance policy, we'll get into what's not covered in some detail, but it is covered, let's say, then those $100,000 that you were insured for now go to your brother in the form of a check, and the agent, which is the person who writes that policy, many times is the one who delivers that check. And so I've delivered many checks of life insurance policies. Believe me, it doesn't get any easier. And I'll make another video if you're in that industry or thinking of getting into the life insurance industry, because one of the things that we need to do, and then I'll get back to this, is we need to empathize, put ourselves in the shoes of the customer, put ourselves in the shoes of the other person, of the beneficiary, and what they might be going through. Going back to the policy, and this couple that I wrote up, about a year or so after we wrote the policy, where they listed each other as beneficiaries, one of the wife gets diagnosed with cancer. And so that was very scary. They called me, what's going to happen, Mike? And everything was in order, right? And so when she did end up passing away, which it was pancreatic cancer, which unfortunately took her very quickly, the insurance company did an investigation because it was within 2 years of having started the policy. And the insurance company that I wrote the policy with was a company that had a 2-year contestability period. A 2-year contestability period, which meant that if somebody passed away after applying for insurance and getting accepted for life insurance, if they pass away within 2 years of having started that policy, the insurance company had the right to investigate and just make sure that everything was done up and up. What do I mean by that? There are some people that when they apply for life insurance, they lie on the application. When you lie on a life insurance application, in this case, they would have passed away within 2 years after lying on an application and they got caught, and I'll give you an example of what that would be like. The insurance company has the right at that point to refund the premiums that were paid, everything that was paid to the insurance company, but not actually cover for the full $100,000 of life insurance in this example. So it's really important that when you apply for life insurance, even though some things may not be the most, let's say, like, we don't want to share it. So like if some of the questions are like, do you smoke? Do you this? Do you go scuba diving, skydiving, things like that, right? Those are the famous questions. You want to be completely honest, because if one were to pass away within that 2-year period, and actually suicide also was under that contestability period within 2 years, it wouldn't be covered. Now, after 2 years, for the most part, the policy was going to cover most anything. And that's what's really interesting is like, going back to this couple, because she passed away within 2 years. Um, the insurance company did an investigation. They saw that there was no knowledge of any health issue and that sort of cancer or anything like that. She was completely honest on the applications. They pull medical records. They do an investigation, and they found that she was completely honest, and they ended up covering. And I delivered that $100,000 life insurance check to her husband. So why am I getting into that? And I haven't even began really a policy review. Is just for you to understand like what is covered, what isn't covered. You want to ask those questions. You want to go with somebody who's been doing it for a long time or really, really knows the product very, very well. Because when you actually get a life insurance policy, most of the time it's a big, thick packet, the actual policy packet. And so what you want to do is every year that you get your annual statement, once you have an actual policy, you want to review it. You just want to make sure your beneficiaries are up to date. If there was a passing in the family and you had them as a beneficiary, if there was a separation in the family, if you no longer like one of your kids or whatever it is, you want to make sure that your beneficiaries are up to date. So going into the policy, I'm going to review one of my policies that I wrote for myself, which was a term life insurance policy. And every year I get that statement. I started this policy, let's see here. I started this life insurance policy in the year 2020. So I actually started in October of 2020. Now, there's term life insurance policies, and then there's what's called either universal life insurance, index universal, variable universal, whole life insurance. Those are the main ones. Permanent life insurance. They have a lot of different names, but you really have two main types of life insurance. One that is meant to be a term life insurance, and term, the T stands for temporary. That's what I always say. So when you think of term life insurance, typically it's going to be a temporary plan. And it can be a 10-year plan. It could be a 15-year plan, a 20-year plan, a 30-year plan. What does that mean? So my policy that I'm going to review with you guys is a 20-year plan. I started it in the year 2020. So this plan, this term life insurance, will end in the year 2022. What does that mean? Well, I'm paying a monthly payment, like we explained at the beginning. You're paying the insurance company so that if something were to happen, they're going to cover your beneficiary. They're going to provide the lump sum of tax-free life insurance in the form of a check to your beneficiary. Income tax free. Now, again, are there situations where it could be taxable? Are there situations? Yes, that's why I'm saying every state's different, every insurance company is different. But in California, and when this policy was written, it was set up so that it was an income tax free death benefit. Okay. Now, it's a 20-year plan. I started in the year 2020. It will end in 2020. It will end in 2040. I'm sorry. So 40 years from the date that I started it. So in the year 2040, I will no longer have coverage through this plan if everything remains the same and I don't make any changes to the plan. That's what's called the term life insurance. Now, the plan that I started, it has level premiums and level coverage. That's really important for you to know when you're looking into it. Let's say that you were to get $1 million life insurance policy and it's a 20-year plan. Does the $1 million stay level? Meaning, does it stay at $1 million for all 20 years? Or is it one that starts at $1 million and decreases as the years go by? Or starts at $1 million and increases as the years go by? You need to look into that. So this one that I have is a level coverage, okay? Meaning that the coverage stays the same all 20 years. The other thing that it has is the level premium. The premium is a fancy word for payment. So every month I'm paying on this plan $96 a month. So those $96 will get me a level coverage, and those $96 will not change for the next 20 years. It stays flat. There are some plans that every 5 years, 10 years, or certain amount of years, that price can change. So you want to look into a level coverage, a level premium, okay, level monthly payment. I pay every month. Now, with the coverage, there's something called, well, let's get into the next thing that's summarized here. It's additional riders. A rider on a life insurance policy basically can be like extra coverage that you want to add. So like if somebody, like accidental coverage, if you were to pass away due to an accident, there could be a higher payout. If you pass away due to or just extra things, like if you were to be diagnosed like terminally ill, you might have access to some of the coverage that you have in life while you're alive instead of upon your passing. So there's things like that that you can look into that are really important. You can add a child rider. So like if you wanted to have coverage for yourself, you get a policy, but then if you wanted to make sure that your children have coverage also, like a mini life insurance within yours, kind of like on health insurance, where you can add your kids up until, I think in California, it's until age 26 they get kicked off, something like that. You could do the same thing. Now, why would a child need coverage or want coverage? There's a lot of reasons. I won't get into that too much. I'll just explain that when you have coverage for a children under your plan, basically you're locking in a coverage for them. We don't know what their health will be down the road, and most likely they'll be healthy, God willing, down the road. But some parents like the idea of coverage for their kids. And so when the child turns 25 in the state of California with the insurance company that I represented, the child had the ability to get, I believe, 4 times the coverage that they had on the mom's plan and go on to their own plan. So if they had $25,000 of coverage under the parents' plan under a child rider, they could turn it into, $100,000 life insurance policy without ever having to go through exams or anything like that. Really, that only applies if, well, most of the cases it'll apply if somebody is born with an illness or something like that, or develops an illness at a very young age. What's interesting about that is that as long as you have one child, you can add that child coverage, but it's the same cost if you have 3, 4, 5 children, which is pretty cool. So like if your family continues to grow, they're automatically born into life insurance coverage under the parents' plan. Won't get too much in detail with that more later, but on this video, but I think it is something interesting to look at. So now you have your beneficiary. Your beneficiary is going to be the person that you select, or persons, right? You can put multiple people. Let's say that you're not married yet and you want to put your parents as a life insurance beneficiary. Let's say that you are married and want to list your spouse, or you want to list your spouse for a percentage and then your children for a percentage. Or what if you're married and you just want to list your children only? You're not required in the state of California with this insurance company. You weren't required to list any person in particular. The one requirement, and we're talking about personal life insurance, there's also business life insurance and key man policies, key person policies, buy-sell agreements. I'm not going to get into that here. This is just from a personal life insurance perspective. There needed to be what's called an insurable interest, meaning upon your passing, the person that you initially listed as beneficiary on your life insurance policy had to have some sort of financial loss, or some sort of a loss financially upon you passing away. You can't just list a random person. They have to somehow have a financial insurable interest in your life, if that makes sense. And you can look that up as to what insurable interest is and whether your state or the company you're applying with requires that. But with us, I couldn't just list a random person. I couldn't just list a random charity unless there was somehow a financial loss to that person or charity, etc. Now, once the policy is in place, you can then change your beneficiary to whoever you want it to be. So, for example, if I initially list my spouse as beneficiary, but let's say 5 years from now, they don't need it or whatever the case, and I want to change the beneficiary to be my alma mater, my high school, whatever, right? Charity, you can do that. You can split percentage. There's no cost to making that change. There shouldn't be any cost. You check, with us, there was no cost, and you can change beneficiaries every year if you wanted to. There was a joke at the office that there was an older gentleman, it was an older lady that kept changing boyfriends, and every time she would change boyfriends, she would call the office and say, hey, I need to update my beneficiary. And so you can do that. Now, one of the things on the beneficiary is really important is children. So if you list children and we're in the state of California and they're minors under 18, legally the insurance company was not able to give them a check because they're under 18. So what you had to do was assign somebody to collect and the insurance for the minor. Now, that sounds like, what's the point of it if the child cannot receive it yet? Well, if you're under 18, you can't claim it. So the insurance company would have to hold the money until that child turned 18 and then give it to them in the form of a check. But who knows how long that is? Let's say you're a young parent and your children are in they're 5-10 years old, and unfortunately you pass away right very soon after, and they're 6, 7, 8, 9 years old. They cannot collect the life insurance unless there was something that you can put another beneficiary, or you can put your children. And then under the state of California, there would be something called the Uniform Transfers to Minor Act. Look into it, but basically you could designate somebody to collect or manage the funds for your child. I always said, and I never had that take place where I delivered a check to somebody who was like the trustee, not a trustee, but they were managing the funds for the child under the Uniform Transfer to Minor Act. So look into that, see if that still applies. But I will tell you that when an insurance company delivers a check, that's it. There's no control on how that money is used. And that's really, really important. If you list a spouse, a beneficiary, if you list children, and then you put this someone as the under the Uniform Transfer to Minor Act to manage it for them, you lose all control. The person that you're putting there, you better trust, because they're the one who are going to essentially have access to the account. The insurance company delivers the check. The beneficiary uses that for whatever it's needed, and that's really important. Now, you can look into a testament, a living trust, a will, all these different things. Typically, a living trust was what was recommended. You can check with a trust attorney to see what the best thing for your estate is. However, that allows you to get more involved now. When you have a living trust, you can have a trustee. You can have somebody who is involved with how the money is actually used when it's in a bank account. You can't just use it for whatever. Life insurance companies just pay the beneficiary. The beneficiary uses it for what they need, most urgent, or whatever they need, right? We've all heard somebody who inherits a life insurance money and then goes and does gambles with it or whatever, right? They can do whatever they want with it. Hopefully that's not the case. So put somebody that you trust. Now, one thing on this term life insurance coverage that I have, and it's really important, is something called the conversion period or conversion privilege. And I just want to wrap it up with this. The conversion privilege means that even though it's a 20-year plan, and I explained that to you guys, it's 20 years. So since I started it in 2020, this policy, the payment and the coverage will end in 2040. And on that topic, there's no money back. There's no return of premium. There's no credit or anything. It's basically you're like renting for the next 20 years with a term life insurance policy. You can rent a house for 20 years, and if you decide to move, you get your deposit back in that case, hopefully. But you don't get any, you can't sell the house, you don't get equity on the house, right? The landlord owns the property. In this case, you're renting the coverage for the next 20 years. That's one way to look at it, right? If something were to happen within that period, you know your family's taken care of. But at the end of the 20 years, if nothing happens, which is a good situation to be in, but right, for us, but as far as the payments, I've been paying $96. So that's close to $1,200 a year that I'm paying for this coverage. Now, 1,200 times 20, that's 21,000. What is that? 1,200? No, that's that's over $20,000, right? So over 20 years, I've spent $20,000 and I get no money back. And that leads us to the conversation, which will be in another video, of the other types of insurance, which do have equity or cash value, they call it, or some sort of return of a premium that can be involved. Can term life insurance have return of premium? I've seen it, yes. Kind of rare in California, but you can look into those and see if there are some that you can pay for 20 years and then they give you your money back. Check into it. But the conversion privilege, what I wanted to explain here was that my policy on my annual statement says I have the ability to convert this coverage until the year 2035. Okay, so I started in 2020, so 2035 would be 15 years from the date that I started it. And what does that mean that you can convert? What does that mean? Well, you can take a temporary or a term life insurance plan and turn it into one of the other ones, one of the ones that will be permanent or universal or whole life or last a longer period than the 20 years, or last until age 121 or whatever age that these policies are set up to last, essentially creating permanent life insurance that will be there no matter what age you reach, as long as premiums are paid and as long as everything is set up that way from the beginning, right? And it's a guaranteed policy. We can get into those later, but term life insurance is very common because it's so inexpensive. I don't like to use the word cheap, but it's so inexpensive for the amount of coverage that you can get. I mean, I've heard some crazy numbers, but it's inexpensive based on your age and your health. So if you're applying for term life insurance and you're 60, you're going to pay a whole lot more than a 25, 30-year-old, 40-year-old who's healthy. Why? Why, if you're both healthy? Because life insurance is based on what's called a mortality table. So these are basically actuaries that have, based on your health and your age and your habits, they can determine how long you potentially can live. Okay. Health insurance is based on morbidity tables. Morbidity tables are how healthy you will be, right? Or what is the chance of sickness in your life at what ages. Obviously, the younger you are, less chance of getting sick. With life insurance, same thing. The younger you are, the chance of it, when you look at these mortality tables, is so small. That's why an insurance company can insure you for such a low monthly payment, because the chance is so small. Well, then why get life insurance if the chance is so small? Well, that's for you to decide. I'm not going to try and go into the sales of life insurance. At the moment, I just want to explain it. So if it's something that you're thinking of doing, it's something that you've been recommended to do by a family member or whatever the case, and you're looking into it, that's what this is for. Not necessarily to convince you to get it or not, but I do want to explain the conversion privilege. This means that anytime within the next until 2035, because that's the year that I can convert this policy. It's 15 years from the date that I started it, even though it's a 20-year plan. So I don't want to confuse you guys. 15 years to convert means that any year up until 2035, I can say, hey, insurance company, change it from a temporary plan to a permanent one or a universal life insurance. Make that switch. Does the payment go up when I make that switch? Yes, the payment goes up because I just went away from renting a term insurance and I moved into more of buying a permanent or a universal life insurance policy. And those plans last a lot longer typically, and those plans build equity or cash value, and those plans are more of a can be a guaranteed coverage for a much longer period of time. So those are the things to think about. The conversion privilege, you want to check if your term life insurance has it, because I think it's a great benefit. Because you could say, hey, I want to rent right now. I want the lowest monthly payment. But then 5-10 years from now, I want to switch it to the other one. The cool thing about it is that you won't have to re-answer any health questions. You won't have to redo any health exams. You won't have to show that you're healthy. What on the conversion privilege, what they do is here it says that you can the number of years during which the term policy can be converted to a permanent policy without additional underwriting. That's what the definition is on my annual statement. So without additional underwriting is a fancy word for exams and questions. Somebody looking at your responses to those and or your results and determining whether you are able to apply for coverage or not. Well, when you have already a term life insurance in place, and if you have a conversion privilege, they will not redo that. They will not redo the health questions or an exam because you already locked it in. And the way that I always like to look at it is, remember at the beginning we said age and health are two of the main factors on life insurance. Well, your age, if you convert this policy, let's say if I were to convert it in 5 years, my age is going to be higher than when I started the plan, obviously. But my health factor, that health rate, is locked in from the original date that I started it. So let me repeat that. When I applied for this policy, I did do an exam and I answered health questions in the year 2020. When I convert this policy, they're going to use the results, the rate that I got in the year 2020, not my age, because my age will be whatever year I decide to convert it, but they'll use my health rate from when I first got the plan. I'll give you an example. If I started this plan in 2020 and 5 years from now, I do have some sort of, God forbid, a health concern or something, the insurance company will not even know about it if I decide to convert it. And it's not that I'm hiding it from them, but that's one of the privileges of having term life insurance, is that you can switch it without additional underwriting. They will honor, quote unquote, the health rate that I obtained when I first got the policy. I think that's a big selling point if you were to look at it from that perspective on a term life insurance, on why to get it. Because some people may say, well, Why rent? Let me just go straight to buying when I can afford it. Well, that's one of the reasons to do it, is that you lock in the health rate that you are currently today, because that could change, right? Again, this isn't with like the push of you should get it, you shouldn't get it. This is just explaining. And the last thing I wanted to explain was, on a level term policy, which is what I have here, a 20-year level term policy, what happens after the 20 years, and when the monthly payment and the coverage ends on that 20-year term? Well, technically, the policy renews, but it no longer renews at a locked-in rate of the $96 in my case. So when it renews in the year 2040, 2041, when it renews, the monthly premium will go up astronomically. And the reason it'll go up astronomically is that the rate's no longer locked. So now, instead of looking at my age when I first applied, they're going to look at my age. Looking here, 2020. They're going to look at my age at that time. And so the price will go from $96 potentially to like $500 a month or $700 a month. Is ridiculous. But that's what happens with these level terms. And that's one thing that's very, I would say, somewhat misleading, is on my annual statement, it says coverage ends in 2085. Why would they put that there? Why do they put coverage ends in 2085 when it's a 20-year level term coverage? Because technically, after the 20 years, even though the level payment ends, it can renew at that higher rate. I don't like that that's put in here, but insurance companies do it. How, why, I'm not getting into that right now. I don't know. Just know that even though it may say coverage ends on this date, you're concerned with the level premium and how many years it's for. And when I would review life insurance policies, I had people that I would sit with that said, oh, my policy it doesn't end until the year 2070 or 2050 or whatever the case, right? Till I'm 100 years old. But then I would look at the actual policy and it would say level premium for 15 years or for 20 years. And typically the max you can get is a 30-year, here in California, a 30-year term policy with a level premium. Well, at the end of those 30 years, same thing happens. The coverage, the monthly payment is going to go up astronomically. So most people cannot keep it at that point. And it really many times doesn't make sense to keep it at that point. But it's a bit misleading. So look at the years of level monthly payments. That's what your concern is. Is it a 20-year? Is it a 30-year? And a lot of times the difference between 20 and 30 years is not that big. I chose, because I wanted less than $100 a month, to go with a 20-year level premium. But I could have gone with a 25 or a 30-year. I just chose the 20-year to have some coverage locked in and then potentially convert it down the road. And with that, we'll close. But thanks for listening, and I hope this was helpful on your journey looking into life insurance. Take care.